Rwanda has no coastline. Ethiopia has no coastline, and yet both countries want a stake in a massive refinery being planned on Kenya's coast. The project has been discussed at around $16 billion. Its proposed capacity could reach 700,000 barrels a day. And Dangote has offered East African governments a combined 30% share of the project's equity component. Kenya is looking at taking 10%. Ethiopia and Rwanda have also expressed interest in the remaining regional allocation. At first, this sounds like a simple energy story. Landlocked countries need fuel. Kenya has the coast, so they want access. But that explanation misses the bigger opportunity. Because buying fuel makes you a customer. Owning part of the infrastructure that produces and moves that fuel makes you something else. A stakeholder. And that is why the real question isn't, why do Rwanda and Ethiopia want a refinery? It's, why do two landlocked countries want to own part of the system that connects East Africa to the global energy market? Before we go any further, we need to separate what has been disclosed from what is still proposed. According to comments from David N.D., Kenya's chief economic advisor, the planned refinery has been discussed at a headline cost of around $16 billion. The broader development, including port and petrochemical infrastructure, could push total investment toward $20 billion. The proposed financing structure follows a familiar model for megaprojects, roughly 70% debt and about 30% equity. On a $16 billion refinery, that would mean approximately $4.8 billion in equity. And this is where the numbers become interesting. Dangote has offered East African governments a combined 30% share of that equity component. Not 30% of the refinery, 30% of the equity. Under that proposed structure, the regional participation pool would be roughly $1.4 to $1.5 billion. Kenya's proposed 10% position would represent about $500 million. And Ethiopia and Rwanda have expressed interest in the remaining regional allocation. That changes the nature of the project. Because the question is no longer simply who will buy the fuel, it becomes who will own a piece of the infrastructure producing it. And to understand why that matters, we have to look at East Africa's biggest invisible constraint. There is no human villain in this story. The antagonist is structural. It's geography. For a landlocked economy, energy doesn't simply arrive, it travels. Crude or refined products move through ports, then across roads, railways, and borders. Every stage adds time, every stage adds cost, and every stage introduces another point of vulnerability. Global oil prices, freight rates, port congestion, currency movements, transport costs, border delays, storage, distribution margins. By the time fuel reaches an inland consumer, the original commodity has accumulated an entire logistics chain around it, and that creates a fundamental disadvantage. The country at the end of the corridor is usually a price taker. It doesn't control the port, it doesn't control global freight, it doesn't control the refinery, and it doesn't control every piece of the infrastructure connecting those systems. For decades, that's been the structural reality facing much of East Africa's interior. But equity changes one part of that equation. It doesn't eliminate geography, it doesn't make Rwanda coastal, it doesn't move Ethiopia closer to the Indian Ocean. What it can potentially do is give landlocked economies a financial position inside the infrastructure they depend on. And that is where Rwanda enters the story. Rwanda's problem isn't that it lacks demand. It's that almost everything it needs to fuel its economy has to cross someone else's infrastructure. The country sits deep inside East Africa. Its energy supply is therefore inseparable from the corridors connecting it to the coast. For Kigali, the attraction of participation isn't necessarily that owning refinery equity guarantees cheap fuel. It doesn't. Transport costs would still exist. Border crossings would still exist. Rwanda would still be landlocked. But ownership could potentially give Kigali something it doesn't normally have, a financial interest in the infrastructure serving its market. That distinction matters. A customer asks, how much does the fuel cost? An owner can also ask, how is the system being built? Where is capacity going? How is supply being secured? Which corridors are being prioritized? That doesn't give Rwanda control, but it could give it a seat at the table. And for a country whose biggest structural disadvantage is geography, even a seat at that table can have strategic value. But Rwanda is only the beginning, because Ethiopia's calculation is much bigger. Ethiopia operates on a completely different scale. Its population is more than 100 million. Its economy is industrializing, its cities are expanding, its transport system is growing. And all of that requires energy. For Ethiopia, the question isn't simply where do we buy gasoline, it's what infrastructure will supply a rapidly expanding economy for the next several decades. That makes Lamu particularly interesting. Kenya's Northern Corridor strategy has long envisioned Lamu as more than a port. The wider LAPSET framework is designed to connect the coast with the interior through transport and logistics infrastructure. For Ethiopia, that creates a strategic possibility. Instead of viewing Lamu as a Kenyan coastal project, Ethiopia can view it as one potential node in a much larger regional system. Port, storage, transport, energy, industrial demand, and eventually regional trade. The pieces begin to connect, because when energy infrastructure and transport infrastructure converge, the value isn't limited to the facility sitting on the coast. It extends into every market connected to it, and that leads to the biggest revelation in this story. Maybe the refinery isn't actually the most valuable asset. A refinery produces fuel. But a network determines where that fuel goes, and that distinction could be more important than the refinery itself. Imagine the system as a chain: Lamu, then storage, then transport corridors, then inland distribution, then Kenya, Uganda, Rwanda, Ethiopia. The value isn't contained inside one industrial plant, it's distributed across the network surrounding it. And this is why the LAPSET connection matters. The broader corridor vision links coastal infrastructure with inland transport and logistics. If the refinery is eventually built alongside the supporting infrastructure, Lamu could become more than a place where crude is processed. It could become an energy gateway. And once you start thinking about the project that way, Rwanda and Ethiopia's interest makes much more sense. They aren't necessarily trying to move their coastline, they're trying to move their position within the supply chain. But there is a problem, a very big one. A refinery capable of processing 700,000 barrels a day needs something even more important than money. It needs crude, lots of it, and reliably. David N.D. has described a potential supply picture involving roughly 600,000 barrels a day from regional oil fields, including production associated with Uganda and Kenya. But proposed supply is not guaranteed supply. Underground reserves are not the same thing as delivered barrels. For those barrels to reach Lamu consistently, you need production, pipelines, storage, export infrastructure, financing, and years of coordinated development. This creates one of the project's most important contradictions. East Africa could theoretically have the resources needed to feed a massive refinery. But turning those resources into a reliable daily stream is another multi-billion-dollar infrastructure challenge. So now the project has two enormous questions. Can East Africa finance the refinery? And can East Africa actually feed it? And even if it can, there is still another problem. The refinery has to compete. 4 risks could determine whether this becomes a regional transformation or a spectacularly expensive industrial experiment. Risk number 1, financing. Can governments and private investors assemble the enormous debt and equity required? A project this large doesn't just require ambition, it requires financial commitments that survive changes in markets, currencies, and governments. Risk number 2, feedstock. Can enough crude reliably reach Lamu? Having oil underground is one thing. Delivering hundreds of thousands of barrels every day is another. Risk number 3, utilization. A refinery this large needs to operate at high utilization to justify its enormous capital cost. If it doesn't, the economics become much harder. And then comes the 4th risk. Risk number 4, competition. Even a strategically important refinery still has to compete. Dangote has warned that African refineries can struggle against imported refined products from major global producers. If international suppliers can sell fuel into East Africa more cheaply than a new refinery can produce and deliver it, Lamu could face a brutal commercial reality. And this is the distinction that matters most. Strategic necessity does not automatically equal commercial profitability. East Africa may genuinely need more refining capacity. That doesn't guarantee that a $16 billion refinery will make money. That's why the next milestones matter. David Ndii has pointed to September for groundbreaking, while Dangote previously indicated construction could begin by October. Those dates matter because there is a massive difference between announcing a project, raising interest, structuring financing, and actually putting heavy equipment on the ground. If Lamu reaches its full proposed scale, the consequences could extend far beyond Kenya. Rwanda could gain a financial position inside infrastructure serving its energy market. Ethiopia could gain another potential connection to the Indian Ocean supply system. Kenya could position Lamu as a major regional energy hub, and the wider East African economy could gain something it has historically lacked: greater participation in the infrastructure through which its energy moves. But none of that is guaranteed. The refinery still has to be financed, the crude still has to arrive, the fuel still has to be sold, and the economics still have to work. Rwanda doesn't need a coastline. Ethiopia doesn't need a refinery inside its own borders. What they need is a position inside the system that supplies their economies. And that is what makes Lamu so important, because this wasn't ultimately a story about one refinery on the Kenyan coast. It's a story about ownership. For decades, East Africa's landlocked economies have largely operated at the end of supply chains they don't control. Lamu offers a different possibility, not eliminating dependence, but moving up the chain of dependence. And that changes the question, not who buys the fuel, but who owns the infrastructure that moves it. Still, 4 questions remain. Who pays? Who supplies the crude? Who buys the fuel? And can the entire machine compete? If the answers line up, Lamu could become one of East Africa's most important energy gateways. If they don't, the same project could become one of the region's most expensive industrial gambles. Because in the end, East Africa doesn't just have to prove that it needs the refinery. It has to prove something much harder, that it can afford to own it,